Hey, good morning, everybody. It's Tuesday, September 13th. This is Gil coming at you with Dr. K live from London. Dr. K, are you there?
Hey, all good here.
He is there. Okay. So anyways, we get usual number of questions when the market's rallying for a couple of days, uh, should we cover, should we buy, all these different short-term maneuvers people want to do because they see the market bouncing around. As I see it right now, and I'll let Dr. K come in on this in a second here, is you have this big break off the peak. I'm assuming everybody can see my screen okay, right? Shoot me some IMs there, people. Thank you. Very good. All right, so basically you've got this breakdown, and now you're in this. It's really, to me, this is just a flag formation. We call it, we like to call it the flag, I'm sorry, the chop zone. And it's really what it is. And you can see it's just chopping back and forth. But really what you're doing is you're building this sort of consolidation. It's like a flag pattern. It's drifting higher. Some will tell you that the market's in a rally and this is your trend channel. I would say if that's the case, then the trend channel needs to be a lot narrower instead of being just wide and loose. So it's not, to me, that's not a constructive trend channel. And what we'd be looking for is a breakdown through here. So right now what we're doing is we have a sell signal from here, and we're still operating on that basis. We're just sitting, got the skews, and we're just sitting, letting the market do its thing, using this as their fail-safe. It's possible you might be able to derive another stop here, but I'll let Dr. K pick it up and make any comments he has on the model right now. But that's pretty much how I see it. And it could chop around for a while, so you may have to have some staying power and not be short-term oriented or even profit oriented. I remember there was one email that came in last week, and it was something on the order of, "My profits are eroding. Why aren't you going to shifting to a buy signal?" And I think that's kind of symptomatic of how a lot of people trade, is on the basis of their P&L, and you don't really do that. You take the signal for what it is. As long as you're not stopped out, you're holding your skews or your TCA or your QID with the signal. So you can see it triangulating. You got this downtrend here and uptrend here, and we'll see where these end up resolving. But I'm thinking that you're going to see it break to the downside. So I'll let Dr. K, you can kind of comment here and give your take.
Yeah, I mean, not a whole lot to be said. As we've said before, we're in a chop zone, so we're going to be volatile, and the market's certainly living up to expectations. And usually these types of messy patterns resolve to the downside and retest lows before they can stage a proper uptrend in earnest. Now that's based on price volume action going back many, many years when you have these types of unusual patterns that are created. So based on that, we do have history on our side, but we also have the fundamental rot that is the backdrop also on our side. So in other words, the problems in Europe, the problems in the US, and a host of other issues that are creating a bit of chaos in the markets. So again, until we see some sort of material change in the fundamentals are where they stand. And that also implies that gold and its younger cousin silver should also continue their long-term uptrends, of course, with perhaps some minor corrections along the way.
So meanwhile, you've got a lot of news, moving the market around. Yesterday, the market was off hard, and it seemed like in the last hour there was some news that China is going to step in and buy some, I guess, Italian bonds. I thought the problem was Greece earlier in the day. I didn't realize it was Italy, and now today that's really not panning out. But I think you'll see a lot of news buffet things around before this thing resolves itself. So you want to try and hold steady. You don't want to get shaken out on these wiggles. We came in with the sell signal here, and you're bouncing around, and we think you're going to resolve to the downside. So we're trying to hang in there for that move. And as long as you don't get stopped out, we don't have a problem with it. We get stopped out somewhere in here, we're okay with it. We're not really going to try and force anything. Just let the trade work if it's going to work. So, but right now, to me, this is normal. When you look at most sharp breaks up the peak, you get a lot of this before it resolves. And you could go last year, I think. And if you look at the market in 2007, when the Nasdaq came off, this won't pick up the volume, but I think we'll be fine just looking at. Here's a peak in 2007. So you come off the top and you chop around for not quite, I'm going to say about 8 weeks, it looks like, before you break down. So you could chop around maybe another 2 or 3 weeks. It could happen sooner. It really depends on how severe the situation is in the market right now. We think the situation in Europe is pretty severe and likely to get worse. So the only way they're going to pull themselves out of it is with more money printing. So that can only be good for gold and silver. So that's really where we are right now. There's nothing really else, as Dr. K said. There's nothing really to think about, and I think you can overthink things to a great degree if you want to, but there's really nothing to think about. Okay, so in that regard, we're on a sell signal, we're sitting. So let's talk about gold and silver, which of course we always get questions about. I always love the emails that come in, and if you see silver doing this, finding support along its 50-day, and somebody will email us asking, are you still using the 50-day as your support level for SLV? And the implication of that question then is that we have somehow, and we're not telling anybody, so it's a big secret, and you have to email us in order to get the answer. So of course we're still using the 50-day moving average as your guide on the downside. And last time we talked to you last week, I said any pullback to the 50-day possibly you have to consider buying into. And so far that seems to be the case with silver, but it's choppy. And again, they did raise margin requirements, I think a couple days ago, or Sunday night, I believe, on the precious metals. So you have that headwind, but for the most part, these things are just trying to chop back and forth and consolidate. And same thing goes with the GLD. It's holding the 20-day. I wouldn't use necessarily the 20-day as a selling guide. I think it needs to stop, chop around in here and probably consolidate for a bit. So the metals are volatile, so you do have to take that into account. If you're trying to make money with the metals, you do have to sit with them to some extent and let things kind of work their way through. And I think that's what you have going on. Gold had a big sharp move. Everybody's now getting bearish. I've seen a couple of pieces last night that gold has seen its top and things could get scary and blah, 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 blah. And really wouldn't pay attention to it, just watch and see how it acts. And for now, all you have that you can discern here is a sharp move up, a pullback on the margin increase, another margin increase in here. So you have another couple pullbacks. But notice how this time around it's not really kicking it down very far, so it's holding up a little bit better. But this is a lot of choppiness, and so I would think it needs to settle down. Dr. K, your take on the metals?
What it's nice is to see that gold had this intermediate term top, came straight down, straight back up, and what it's trying to do is gain some stability. And that's a great sign that the fundamentals are still intact. Because normally when a company goes straight down and straight up off a major top, it doesn't wait around to head back down and retest those lows through price volume action and quite a bit of volume.
Dr. K?
Yeah, can you hear me?
Yeah, I can hear you. How about a precious metal? You said a company, but this is a precious metal. So precious metal, the same thing?
Yeah, no, precious metals, these kind of focused ETFs that are focused on one commodity or maybe just 2 or 3 commodities tend to trade a lot like stocks. They tend to trade with cleaner patterns. And so they do tend to have these cleaner signature tops, just like we see in stocks. And so with gold, this normally would look like an absolute top, but because the fundamentals are so intact, to me, this action is what I would expect given the fundamental backdrop. And I want to make one comment on silver using the 50-day moving average. What could very well happen is if you go back to middle of 2010, you'll notice that it tested the 50-day and then it went sideways, and it went sideways through the 50 days. In other words, you would use the low of the base as your selling point. This would be June, July, August 2010 on silver, SLV.
June, July, August. Back in here? Okay,
yeah, back in
all right.
So what we're going to see, what we could see is that kind of action where, in other words, essentially we had a move in silver and then it broke down through the 50-day, which could have been sold, and then it based out. as you can see, it never undercut those lows that it hit in early June. So, in other words, what we're seeing now with the pattern of silver could potentially trace out as similar to what we saw in, say, August of 2010.
Mhm. Right. So maybe a dip below here, and then you try and come out again. So
Right, but as long as it doesn't undercut that low of about 36, I would, and again, if the price volume remains constructive in that it's certainly tracing out a basing pattern, I would do my best to hold the position as long as it stayed above that 36 level.
right. So that's pretty much the story with silver and gold, everybody, in the market. Okay, so we don't want to take up a lot of time today. Our objective going forward with these webinars is to cut to the chase and not waste a lot of time dilly-dallying around so we can get right to the heart of the matter. So today, you know, same thing as we've been saying with the market. You're just bouncing in here. You're in this choppy channel. You're going to roll over, we think. So that's kind of what we're playing for. So you get yourself in position. And we got the 2611 zone on the NASDAQ Composite is your fail-safe. We know what our stops are on the metals, but I would say on the metals, you know, don't expect any instant gratification if you come into these and there's something going to launch to the upside. There is one potential problem that could arise, and let's say we get into a very nasty sell-off in stocks from here, and it is driven by forced selling as everybody rushes to liquefy, and you have financial institutions backing away and trying to raise cash levels to deal with potential defaults in Europe. And you know, now we've got French banks are suddenly a problem. Societe Generale, I guess, is heavy in the derivatives, and people are talking about them being an issue here. So you know, I think if you start to see that, and you start to see some heavy selling, so they could start to take out the metals, but I don't think you really anticipate it. You wait until you actually see it, and then you can react to it at the time. And by the same token, I don't think you should necessarily be fully weighted in the metals. I think you should have some position there, and then be playing on the ETF side with the signals that we're getting from the market direction model. So, you know, there's not really, in my view, a sort of full-bore way to approach the market, especially when you're in the chop zone. So, you know, where are you going to find any instant gratification if you're really looking for it? Well, I guess you could try the short side. So we've talked about a couple of stocks recently, and Fossil's one of them. And, you know, the way we see that, you got a left shoulder here, you got a big head, you get this big break, and now you're chopping around in here. You're in a right shoulder zone, but you could rally back up into the 100 level. You can maybe even rally up this high, although I would expect that the right shoulder here should stay below the left shoulder. So, you know, it's holding the 200-day moving average. I'm looking for it to roll over and break down through. If it can't, then I'm not going to get too aggressive, but I'm not afraid to test it here. It may turn out that this is the high you're looking to short into, or the 65-day exponential as it comes up. So, you know, you can play with those. Not necessarily clear that you're going to make any money until you see the NASDAQ Composite, the Dow, and the S&P, and all the major market indexes roll over on the next leg down. So, you know, where you're seeing the NASDAQ here, probably, let's do this, and we'll put the market together with the stock, and you can see in the NASDAQ, there's certain similarity here. So what's likely to happen is you're going to have to see the market roll over and break down, and these are going to get taken down similarly. And you'll see stocks that are probably ready to break down will get into sync with the market, and those that are most in sync with the market. So, for example, Fossil looks this way. I think Open Table looks the same way. It's in this sort of channel here, but notice it's a weak channel, and it's making a lower low in here. Today you got light volume. 55 area seems to be pretty solid resistance. You could have gotten into it on this day when we were talking about it around 57, 58, 59 on that day. But that's kind of holding there. And this is a reverse flag. And people ask us, well, what's a reverse flag, or could you talk about it? I guess we could talk about it. I'm going to waste a lot of time. But the bottom line is all it is a consolidation of a prior downtrend. In the same sense that a base, flat base, or whatever other kind of base, double bottom, whatever, is a consolidation within an uptrend on the way up. then a reverse flag or any kind of a reverse consolidation is just consolidating a prior down move. And so what you look for is a breakout through the lows, telling you that it's going to continue lower. Now, in the case of open table, for example, you have this reverse or inverted flag type formation, and it's coming off of this, here's your left shoulder ahead, right shoulder, and so it's broken down. If you draw the neckline in here on a weekly chart, you've got this. This is roughly your neckline, more or less. I mean, it's not an exact. You got a lot of lows in here that you can draw. So roughly draw it in here. I'd say that's your neckline. You broke down through it. Now the upside here on the neckline is probably resistance. The 10-week or the 50-day moving average is catching up pretty quickly. So you might look for that to be upside resistance. Now, if this is breaking out from here, I would expect it would head down into the mid-40s from here. But it's still, jury's still out. You still could get a rally here. And again, it's going to depend on what the general market does. So you really have to key on what the general market is doing. If you don't, and you try to just get very aggressive when the market is going to push the other way on you, when it really isn't confirming a breakdown yet, you might get pushed out of your positions prematurely. So you do kind of have to work it, and I'll come in here and short a little bit, maybe cover, make some money one day, and short a little bit, and then cover, and maybe lose a little bit of money and really get nowhere. But I'm testing these out in here. But so far, this one is working to the downside, specifically if you were listening to what we were saying on this day, because we felt it was ready to break out, and you can go back and review that email alert. So. And with it breaking out now, what you're looking for is resistance somewhere in the 55, 56 level, and so far that seems to be the case. So, it's doing so far what it is allowed to do. The other one is fossil here. Again, if we're looking at what it might be allowed to do, well, it could be allowed to rally back up into this part of the pattern. I watched the volume today. It's not really very heavy, so it's a little bit on the feeble side, and it is a volatile stock, but what I really want to see is a breakdown through the 200-day moving average, and you can see that on an intraday basis. It's done it twice before. So I'm hoping the third time, using the rule of 3, is the one that, when it comes back again, this time it goes through and heads for the lows down around 70. And that would be my downside target if you're shorting on that break. So those are really the only two. The other one that we've had out there is Monsanto, and that was on the basis of thinking this was a pocket pivot. You can see my briefing.com.
CRM.
Some news on CRM. I use this, and everybody, you can use this. I think it's free, or you can pay for their professional version of the news. But anytime you have something that goes off on something you have entered in your symbol watch list, it will give you that little alert. So that's useful in that sense. But anyways, getting back to this was shortable up in here. You can see how it breaks down. Now it's doing the same thing as the market. So you see this stock is mimicking the market as well. Okay, so it's also on a relative basis somewhat similar, but a little weaker. It's already tested the lows. So if you short it in here, you're covering on this undercut, and now you're looking maybe to get back short on this thing again. And it may need to go a little higher. But you kind of watch what the market's doing. You'll notice very similar, mimicking the action. On the other hand, if you look at something like a price line, which did have a nice failure here, we did pick up on that when it occurred, but notice how you rallied that very quickly. This is not mimicking the market, so I would be less inclined to want to short this because it's not doing what the market's doing. Stocks that are mimicking the market, then you want to synchronize those with the market or see them move in synchrony with the market when it breaks down. So. And so those are really the 3 stocks we've been looking at. Some others, I'm testing out a little short today in this soda stream. Here you got a shoulder here, left shoulder, big head. Now here's the classic pattern, is the big, giant, huge volume break off the peak. And then you get this pattern. So this becomes your left shoulder. And now this is all below this area here. So I would imagine that this is going to get too much higher than, say, 42, 43. So start putting out a little of it here, maybe set a stop at this high, 42.50, something like that from here, and it might work. But what I'd be looking for here is a right shoulder to form and for this to roll over. What's a little bit problematic with SodaStream is that the 200-day or the 40-week is up here, and the 50-day is way up here, so it's way below its moving averages. So it could rally up in here, and after a few weeks, it could work its way up. if the market continues to chop around. So those are all the different possibilities. Right now I'm looking at this area, because you have this area of congestion right over here, I'm looking at this area as being possible resistance right now. If it's able to work its way through there, it might get up to the 40-week 200-day, but these are also going to start to drift down and roll over here. So they may meet somewhere in here, and that would be logical. So you're kind of watching this one right now, but I do like focusing on the weaker patterns that, again, are mimicking the market. Break hard, you're in this reverse flag. Break hard, this reverse flag is actually also forming the right shoulder in what could be a head and shoulders formation. So you don't always see a lot of head and shoulders formations, but when you find those few that you do see out there, you want to jump on those. And I think you want to stick to those that, number one, are mimicking the market and are as weak as the market, because they will break down if the market rolls over, and that's kind of what you're playing for right now. So, there's some others that we've played before. Finisar was another classic formation. Here's a left shoulder, here's a breakdown. Remember, we were shorting it in here and got this nice break. Now it's rallying all the way back up into the lower part of its right shoulder, and you're kind of bouncing around in here, and I wonder if this thing's going to roll over again. Yesterday, Broadcom announced that they're buying NetLogic, which I think is considered to be in the same group. Let me see if that's true. Well, I think that it's one tech company buying another. I think that may have had some lift on the stock yesterday. But I'd be looking at this one potentially as a short coming up into 21, 22, maybe even at this area, and see if it breaks down back through. Here's the 10-week moving average here, and see if it rolls over through it. Because if you go back and you look at patterns like this, so let's just go back and look at Crocs, for example. And you go back to 2007. When Crocs broke down, okay, this was the bottom of the right shoulder, and it rallied up into it, and that was a resistance area, and then it rolled over again. And so it went a lot lower. So my point simply is that you think if it's broken down here and it's rallying up in here, that this is as far as it's going down. That's not necessarily the case. So when you look at Finisar now, this is rallying back up into the lower part of the right shoulder here, and it could easily roll over. So that's one to keep an eye on. I'm focusing on these types of patterns and those that are mimicking what the market is doing. So that's really the key. So I'm kind of keying on these stocks. There are some others that we've talked about. For example, JWN, Nordstrom, DEC. These are right at shortable areas. And this one's kind of breaking out today. But this is a difficult one to short. It should have broken down in my view, or it may reverse and break down. So you could keep an eye on that. But again, ask yourself this: are these mimicking the market? Well, to some extent, Decker's not really. It's a little higher up in its pattern. It's not as far down. You might look at something like JWN, and it's kind of doing the same thing. Not as weak as the market, but could be shortable here. Quite possibly. I'm not going to tell you it can't be shorted, but you got to use your stops. So then there is a prior breakdown, so it could be a late stage failed base, and it is going to break from here. So, but on the way down, it's going to find areas of support, so it won't bust wide open. I think you have a better shot, possibly, with something like an open breaking to the downside, because there's nothing really below it, or I think Fossil is in a better position just because of the big break and this prior weakness. So I think at some point this is going to roll over, so you definitely want to be keeping a close eye on that one. Let's see. Let's go through some questions. So that's where I'm at with stocks I'm looking at on the short side. I probably should cover these really quickly. Same thing here. This is mimicking the market. We told you about it here. And of course, if you short it, you're up a little bit, but it's not really coming to full fruition yet. Probably needs to break with the market. Same thing, but that's a good target because it is mimicking the market, and it's as weak as the market is. Other ones like Tiffany, for example, it's mimicking the market as well, and it may need to get up into the 50-day here. But again, you got a left shoulder, so it's got some room in here to rally. If it got up to 73, close to the 10-week moving average, maybe I'd be looking to short that one. UA is another one. Similar situation. So these are all in position where you can test them on the short side, but whether you're going to be successful or not is going to depend entirely on what the market does from here. But, I pretty much summarized it and distilled it down to a couple of key points here that I think you should take into account when you're looking to get short. And you start out, you know, if you're crazy like me, and I like to go in 200, 300% intraday, you know, you take 4 positions, say 25% each, and see if they don't stop you out, and then you kind of build them up. And I'll do that, get them up to 50%, and try to run them real tight. Using really tight stops, but it's, you know, there's no, I don't have a formula I operate off of, because I know people are going to ask me, like, how do you calculate your stop level? It's like, you know what, if it looks like it's going to run away, I'm out of there, because I can always come back and try to re-short it. So those are my thoughts on those stocks. GCC, someone asking us about that. That's what is it? Commodity, looks kind of boring to me. PPLT, which is platinum ETF. It's like, you know, to me this is the weakest of the 3 metals, if you want to think about it. Physical platinum shares, the iShares Silver Trust, and the Spider Gold shares. You know, those 3, which is the strongest? Well, GLD is, and then the SLV, and this is the weakest. So why bother? That's what I take. That's my takeaway from what this chart's saying. Dr. K, what's your take on platinum versus the other 2 metals?
Yeah, basically the same read. You know, until it really starts to show some muscle, I prefer to have my money in a faster horse like gold or silver.
Yeah, same here. Is there any place on the charts, Dr. K, this one for you, is there any place on the charts or with the price and volume action and the indexes one might add to existing short ETF positions? I think that's a good question. And Dr. K, what would your answer be to that?
Yeah, when it comes to pyramiding an ETF, there's nothing wrong with that. In fact, in a choppy market environment like we saw for much of this year, I encourage it because, in other words, when you go in with your initial position, it's going to be smaller than your normal size position by pyramiding in slowly. So if the model has a false signal, and we all remember, you know, the model, earlier this year, there was a lot of turbulence and go-nowhere action in the market. So the model had a number of false signals. Granted, the losses were generally kept to less than 2%, but you could lose even less by pyramiding in slowly on a change in signal. And so if you use that style, as the trend continues, you can continue to buy into the spoken for ETF, whether it's a 1, 2, or 3 times ETF. You can just continue to add in your position, thereby essentially making the volatility of your account much, much less, because you're getting in slowly, and then when it's time to finally get out, you can just sell your whole position that's accumulated over those series of buys.
You see the market's getting a little momentum here on the upside. I think you're just going to be chopping here, but look for this thing to roll over. So I wouldn't really look for this to sustain itself, but we're not going to try and second guess the market today as we watch it bounce around and go up and down and every which way. So let's see here. Why short stocks with patterns that look just like the market when you can just short the market? That's a good question, and it's true. You know, why you can just go along the SQQQ, so that's an easy way to play it. Now, the difference is you might get better juice out of it. And sometimes the indexes can rally and a weak stock won't follow the market. So you're right, you can use any of those. You know, I might also hypothesize that if the market rolls over, they're going to take a lot of these big stocks, like, let me get back to this chart, like Amazon, you know, Priceline, Apple, they're probably going to take all these and, you know, break them down. So yeah, that would be the thing to do. But right now they're not really showing any signs of breaking down. So yeah, that's why the model works as well as it does. So Dr. K, how would you play the TVIX? Where'd you come up with that one, anyways?
Actually, it was a member who tipped me off to how profitable the TVIX can be. And I've looked at the TVIX back earlier this year, and I was kind of amused by it. You know, it's a 2x ETF. It tracks twice the volatility of the VIX index. And so consequently, when the VIX gets volatile, it moves all over the place. And being that TVIX is twice the volatility, this, I would say, is the most volatile ETF in existence right now. Therefore, it has to be handled with utmost care. However,
Yeah,
I
no
will be
kidding.
making some. Yeah, I will be making some recommendations on using the TVIX in upcoming signal changes. I would imagine I would have to see enough evidence of a very weak rally and higher probability of the market retesting prior lows for me to go in and suggest that someone utilize the TVIX, or they could use the 1X version of this as well. So, but it moves all over the place. So I'm going to be very cautious in how I recommend this vehicle. But we already have some members that are already using it to their advantage. And yeah, if you were to use the TVIX, buying the TVIX on a sell signal issued by the model, or shorting the TVIX when the model issues a buy signal, it's amazing how much your account would be up, or how much that particular strategy would be up since August 2nd. And I calculated 348%. And I actually recalculated it 3 times because I just couldn't believe how the numbers were so huge. But indeed they are. But keep in mind that we had a big market break on August 2nd. And so when you have big breaks like we saw, the VIX is going to go through the roof. And I would imagine that if the TVIX existed in late 2008 when we had that slow motion crash, the profits would have been even greater.
And that was not the TNA, that was a TZA, right?
What about the TZA?
Was that using the TZA, that calculation? Because I noticed there was, I think it was a typo in the email that you said TNA, and it's actually the TZA, correct?
No, what the email was illustrative of if someone had gone long or short the TNA, the TYH, okay, or the TVIX. So in other words, I had one person, he needed some clarity on, he said, well, wait, the TNA has gone down. Well, yeah, it's gone down, but if you short it on a sell
right, I got you.
Yeah, which is how the model is tracked.
See, sometimes you even confuse me on those. Okay, here's a question. When shorting a stock that breaks a moving average, is the break the same as Dr. K's violation of moving average or different? For me, it's just that's the signal that I'm looking for weakness. So if I'm looking at this, for example, and this is, of course, the one we're watching here, it just have to break. And so even though you could be shorting here and hitting it, what I would do, and sometimes the way I'll approach this is hit it here and then maybe use a stop real quick to get out and then try it again and maybe get pushed out again. So you'll have to test it a few times. But the other thing to do is just short into the rallies here and using a stop somewhere up in here. That's the other way to do it. But you can see, though, that you did have 2 breaks. The second one occurred on lighter volume. So it doesn't really want to break down yet, but we'll see what happens with this one. I think the jury's still out. And it could continue to rally higher. So, I guess if the market turned around, it could continue and just build a new base. But for now, don't necessarily use the same thing as a violation. I don't. You could, I suppose, if you wanted to run it that way. So not, in other words, not short a stock until it actually violates. Now, like for instance here, you see it breaks down. Now here's the violation because you closed below the 200-day here. Now here's the violation. So if you went short there, it got you in, but you probably get run out pretty quickly. So because things are so volatile often on the short side, a lot of that stuff doesn't work as well, and things can really jump back in your face on the short side. And if you're late to the party on the short side, usually that's what'll happen. I think once you've broken down like this, you're a little bit late. So I'd rather try to get in a little earlier, either on a bounce, shorting into a bounce, or just as it's starting to look like it's going to break. Because then if it doesn't, I'm getting stopped out at less of a loss. And that's really the key. I can take getting hit 10, 15% in aggregate on the short side as I'm building into positions, because once the market breaks, you can go up very quickly. But you have to keep that in mind, and it depends on your psychology how well you can handle that. So know thyself if you're going to short, otherwise stick to ETFs. Pyramid points in the indexes. There really aren't pyramid points, right, Dr. K?
Yeah, the indexes trade fairly sloppy in relation to pyramid points. So if you're going to pyramid into an ETF, I would use it on a price basis, purely a price basis. So in other words, you could say when the TNA moves up X%, you're going to add X number of shares each time.
So you're short.
Yeah.
Yeah. Some people ask, wow, how do you manage your DNA on not taking these 4 to 6 point moves in TNA and TZA as we chop zone this market? I find it hard to just sit on an entry point when it seems it will come back 50% or more against my entry. Um, well, I don't know. I can handle it, but the account that I use to run the ETFs in is not the same as my short sale trading account. So it's a lot different there in terms of where I'm running those, and I take different views in terms of my time frames depending on which account I'm running. So I actually have several accounts. So when it comes to doing the ETFs, I just buy them and sit, and that's it. I don't even look at it. I know where my stop is. If it stopped, it stopped. I don't even watch the P&L really to see how that's panning out over several days. So it keeps you out of trouble. And again, if you're trading your P&L and something is very volatile, then obviously you're going to feel a little bit frustrated because you're going to see profits come and go and come and go and come and go. But the idea is that hopefully they're going to come one last time, and that's going to be the big one where it breaks down to the downside and you're up, a good percentage, like you could have been in August off of the August 2nd sell signal. So, it's not that easy, but I've learned. I decide what I'm going to do, and then I just leave it alone.
Yeah, I think it's really important that this applies to any form of investing in the market, that you understand the volatility of the instrument you're dealing with, and you portion a certain percentage of your investment capital into that vehicle. In other words, if you have your money spread out over several accounts, and you're going to use one account that represents 10% of your net worth in this highly volatile ETF, if you're okay with the wiggles, the big swings in that account, because it's only 10% of your net worth, then you should. But if some people I know gets very very seduced by the profit potential in these 3x ETFs, and they end up putting too much of their investment equity into that vehicle. So if let's say your hypothetical is, let's call it 1,000 units is your investment account. We're using units here. So you're putting 700 of those 1,000 units into a 3x ETF. That's 70% of your net worth. That might be just too much volatility for you to stomach. But every investor has to figure out where their comfort zone lies, wherever that is.
Yeah, so there's no secrets, no magic. Someone asking us our thoughts on VRUS or VRUS farm asset. I don't know. It's broken out, so here it is, breaking out and going higher. Should you buy it? I don't know. Is it going higher? Maybe if the market goes higher. So if you bought the breakout, then you're doing fine. Fossil rally today on the light volume. Yeah, that's what I'm noticing, but it's still pushing, so maybe a shot to come in here. I think in here, using a 101.81, that's a pretty close stop, 5% from here, or you use this high. It'll be interesting to see what this thing does by the close, though. Somebody asking EUO. What is EUO? The ultra short euro? I mean, I guess you could play it, but it doesn't thrill me. How about you, Dr. K?
Yeah, well, I mean, it's a bet on how bad things are going to get in Europe and when they're going to get bad. And keep in mind that we have Germany attempting to rescue Greece. There's these other countries that are potentially too big to bail, if you will, and that could create a toppling effect or serious further problems for the euro, which would cause something like the EUO to move higher. But again, it's a timing gamble. It's a gamble on politics and a lot of what I consider unknowns in terms of how they play out and when they play out. So I'm not very interested in trading something like EUO simply because, in fact, O'Neill was always fond of saying this, I don't predict, simply because it's variables.
The dollar is rallying here. Is it going to continue? Is it breaking its downtrend? It's had these kind of rallies before, so I don't really know that this is it definitely, the dollar is the tallest midget right now, so it's getting a bid, and kind of like it's really the inverse of the EUO, the euro. So when you're looking at the inverse euro, you're looking at the dollar, aren't you? So it's just a fear trade coming into the dollar, which is the tallest midget right now. So, those aren't anything we're going to play. We don't need to play. Let me ask about this stock, Zillow. I don't know. Thin stock, doesn't trade enough for my taste. So whoever got bought in here was really sucked into that, weren't they? Anyways, I think that's pretty much it. I don't see any other questions out there. We're in a pretty, stable,
WLT.
View right now in terms of just letting this bounce play out. As long as we don't hit our fail-safe, we're just hanging out. So that's really what's going on here. There's no real magic here. And that's pretty much it for now. So let's see a couple more questions, and we're going to wrap it up in 4 minutes. PetSmart, how about it? Broke out, and it's still going up. And you have some others that have broken out and are holding up. Hanson's is still holding up okay. We're looking at Amazon yesterday because this looks like a pocket pivot right here. But it's kind of an unstable pattern, so it's not really clear if this is really going to work. So there's really not a lot. What other stocks have tried to break out? MasterCard tried to break out, and it failed. So not a lot of success. We don't think you're in the kind of market where you're going to have a lot of success on the long side. Sure, there'll be a stock here and there that you can buy, and if they hold their breakouts, they're fine. But there's no magic answer in terms of them necessarily holding up, or not holding up. So GMCR, yeah, it looks like a pocket pivot, but it's stalling. So Ulta, it's coming straight up off the bottom, so not really interested in that. Wouldn't buy that move. So, and Michael, you did call that correctly. Somebody says SLV chart. I don't know what that means. Look at the chart. It's holding the 50-day. Looks fine. What else? Any other questions? There are some breakouts. Yeah, there are a few, but nothing that gets us excited enough to think that the market's changing trend. So we're staying with the sell signal. Q-Core. This is a stock we talked about before. Is it breaking down? Well, it broke the 50-day moving average here on pretty heavy volume. So, Dr. K, if you own that stock, would you be holding it?
Well, this is a tricky one because well, at first it violated the 50-day in August. So in a sense, it's not really tricky because I would have been out of the position on that 50-day violation. Actually, I would have been out of the position when it violated the low of the gap up on July 27th. And I would not have bought back into it. But if someone, let's say, had, you had two selling points. You had the violation of the low of the gap up day on July 27th, and then you had the violation of the 50-day on August 22nd. And then yesterday, it just collapses. So, I mean, you should have been selling yesterday. If you haven't sold yesterday, I'd be selling today. It doesn't look good on the pattern. I don't like
it. Doesn't look too good. Here's another one people are asking about. Universal Display. It's trying to break out, so if you want to buy it, I guess you could buy the breakout and just use a standard stop. But it's still, if you look at this pattern on a weekly, it's got this straight up off the bottom look. So usually these need more time. I bet you this doesn't hold up unless it's a buyout story. That's the only thing I can think of.
The earnings are still negative. Yeah, earnings are still red on this thing.
So
revenues aren't. I don't know. It's just it's too risky, especially in this kind of market environment.
Right. Athena Health, you had a pocket. It's just a jagged here, so it's trying to break out again. So, is it going higher? I don't know. Yeah, there you go. That's one. You see, it's broke down with the market. It's leading the market. So, Ancestry.com. I've been watching this one, and you're getting this sort of weird looking boxy head and shoulders. So yeah, this one's breaking down. It's starting to break out, but it may just undercut here and rally. That's a good one. Whoever came up with that one. That is Door. Okay. Yeah, that one, and that's another one that's looking like a head and shoulders top here. It's rolling over. And this is a prime stock again, you know, these prior leaders. So here's a question for you, Dr. K. You ready?
Yep.
All right. I know you never average down, but for instance, if I was long the SLV around 39 and pocket pivot showed up around 36 level, would you add to your position?
Well, if my initial position, say, were a half position, less than a normal sized one, and then it's set up very well in a constructive way, yeah, I wouldn't have any problem averaging down in that case, just knowing that my position size still represents a normal size position.
Yeah.
I only like to get big in a position when I can average up, and bigger than normal, shall we say. So that would be one case where I wouldn't mind averaging down.
EDU, don't really care for it. We're not interested in being long stocks primarily. So when you ask us about stocks on the long side, we're not interested in being long here at all. We don't believe that you're in a bull market. We think you're in a potentially a longer term bear market, and that it's going to go on for some time. So we think if you're buying stocks, you're just getting sucked in to things. So
Of course, that could all, you know, the market can turn on a dime. Bernanke can come in and talk about QE3. The markets could set up an issue of follow-through day. So you never, you never really know what could happen. But right now, we're not looking for anything on the long side. It'd have to be quite exceptional for us to recommend something on the long side.
Yeah, we're back now. Dr. K is, he likes London, but he's had residences here in Beverly Hills, where he spends part of his time, and South Africa. You're basically a world traveler, right, Dr. K?
Yeah, I like the phrase that James Nishener, the famous novelist, used. The world is my home. I feel I feel I can go anywhere in the world and feel quite at home.
You know, when I need him back in L.A., I tell him to get his butt on the plane and get back home to L.A. But it seems like he's a GQ Euroflash dude.
Yeah, I mean, we're getting your butt over here. When are you coming? Later this or in the spring, right?
Coming in the spring. Anyways, all right, let's not waste time here. What are the traders do? Well, we're not going to get into general questions. If you have general questions, again, email them to us for next week's or later this week if we do another one, say on Thursday. Email us your questions and we can line them up. It's a lot easier than trying to answer them, especially when you want us to pontificate on what other traders you consider good. The alert service I use is briefing.com. So just so y'all can see here, this is what it is, and it shows all the headlines, and you can come in here and my ticker watch list, and you can enter in tickers here, and you can see I have a bunch entered in here. So when any news comes up on any of these, you click here, in-play audio alert, so that it will give you the audio alert when a news item related to one of the stocks that you're watching goes off. So it's pretty useful, and I think there's a free version. I think you can get alerts with it, but I use a professional version. It's only $35 a month, so if you're too cheap for that, then you probably shouldn't be investing in the stock market. So anyways, I think that's pretty much it. So thanks everyone for showing up. Keep watching your email box. Possible we may have another one on Thursday. We thought today would be a key day because we're thinking and looking at the potential for the market to roll over here. And that's kind of what we're leaning towards right now. So we'll see how this pans out. But really, the jury is still out today, obviously, as you can see. But it's kind of feeble, and I think they're bringing in what I like to call the dope of hope, where people think that Europe's problems are going to be solved. I think you're going to see something or somebody somewhere go under, either a bank or a country, and then all hell's going to break loose. So that's just my take, but that's just my opinion. And we'll just see where we go from here. So we'll catch you guys next time. Thanks for showing up, and take care. Good luck.
So long, everybody.